Over the past 5 years, the FTSE 250 has risen by around 70%. That's more than double the 31% gain seen on the FTSE 100. But this past year has seen the FTSE rise 13%. That's compared to the 250's 3% gain. Looking ahead, with a weaker sterling looking to be one of the dominant themes of 2017, the 100 could yet again beat the 250 as investors seek safety in lower risk large cap shares. Well, Andy Brough is from Schroders and 250 is his area. What have you made of this year and what can we take from that into 2017?
Well, this year we've had Brexit, we've had Trump. I don't think I can stand any more excitement, really. It's been a year where actually the fundamentals of the UK economy have been quite solid. If we believed everything that people were saying after Brexit, then we'd have sold our house, we'd have emigrated to Europe or the US. But in the meantime, the UK economy continues to create jobs, continues to grow, and looks far better placed than quite a lot of areas in Euroland, I think.
But the uncertainty around Trump, around Brexit, is still there and is still going to be ongoing into next year, and that's why perhaps people are looking to the 100 more than 250 at the moment?
I love this idea of, a flight to safety. Equity is a risk capital. And equity is what you've got left after you've paid off all your debt. Yeah, all the company's paid off all its debt. So when you look at it, you want to be in companies which typically are going to pay you a rising stream of dividends from a rising stream of earnings. Now, when I look at our sort of investment trusts, the underlying companies have increased their dividends by circa 20-25% this year, far faster than you've seen in the FTSE 100. Indeed, the payout ratio, i.e. the amount of money a FTSE 100 company is paying out as a percentage of its profits, is currently about 70%. Big number. In the 250 it's sort of 48%, but people have gone weakness of sterling. Fantastic. 70% of earnings of the FTSE 100 are overseas. Let's get involved there, and that's what we've seen. And I think fundamentals will reassert themselves. We've been through periods like this before where people go, that's it. After Brexit, my mum phoned me up and said, my portfolio, it's all over. I've got a lifetime of penury ahead. And I'm thinking, Mum, you're 81. Anyway, I said, look, Mum, have you got more income from your shares this year than last year? She said, don't be stupid, you're an idiot. My portfolio's collapsed. And I said, Mum, just do me a favour, go and have a look. She said, well, I have. So I said, look, so actually fundamentals will reinsert themselves. Yeah. But that's what will happen next year.
How much will they reinsert themselves? Because that weaker sterling story is still going to be there, and a lot of the stories of this year are still going to be there. So how much will the fundamentals come back in, and so what are you looking for from the 250?
Well, I think what I'm looking for is, against the euro, I think sterling will be back to where it was pretty soon. So if you think, don't buy your holiday currency just yet, that's not a forecast. Against the dollar, it might be a bit of a longer haul, but because the US is sort of putting up interest rates. And, everyone thinks the 250 is just sort of domestic, but over 50% of their earnings come from overseas. So what we're looking to do, our job is to try and get 250 companies into the 100. It's very much what I call the Arsene Wenger School of Fund Management, which as a Spurs fan pains me to say.
I was going to say, that must be really hard for you.
It's very hard, but if you think about it, what Wenger does is he sort of buys players when no one knows what they do, like Thierry Henry, turns him in from a winger to a striker, lets them perform fantastically, and then when their ability to perform is gone, he sells them while people still believe in them. It's no different from a 250 company, sort of growing, getting to the FTSE 100, and that's as good as it gets.
There is one slight flaw in his plan, though, of course, isn't there?
Who?
In Arsene Wenger's.
Go on, what was it?
Well, that is the actual ultimate end result.
Yeah. Yeah, I know.
Is that the same then for the companies, FTSE 250 companies?
Yeah, because what happens then is they lose their ability to perform.
Yeah.
That's it. And so we recognise that, and we've sold them to the FTSE 100 buyers, and they think they're great.
Come back again.
And then they come back and reinvent themselves. That's what happens.
Okay, so where sort of are we looking for in terms of the FTSE 250, where we're trading around the 176 level at the moment? What would you be looking for the 250? Well, or is it more of the individuals rather than the index as a whole?
It is more the individuals, because you've got such a wide variety of companies in there, from Just Eat deliveries to house builders to properties to quite interesting technology companies to niche pharmaceutical companies. So you've got a whole wide range. You can't just go, it's a blanket buy that index. You've got to look at the stocks.
Well, let's look at the individual ones. I know you've always been sort of house builders has been one area that you've always looked at. Does that continue? Yeah,
we still are house builders, because you look at the dividend increases. Redrow was sort of 60% buying back their shares. Bellway, reasonable trading statement. At the moment, people just think no one's ever going to buy a house again. In fact, cycling to work, I actually stopped by the sell boards to check they're not just advertising Christmas fairs.
Which often they do.
Which often they do. But population of the country is still growing. You cannot live in a virtual house.
Come and live near me and you'll see all the houses going up, and you know there's no issue with the house builders at the moment because they are just flying up. Let's look at then some of the companies. Yeah. If not you're still with house builders. Are there any other areas that you want to be looking at?
Well, we're trying to look at those companies which perhaps have had a tougher time recently, reinventing themselves. And I've kind of picked out sort of three, or companies which are changing. One thing we look at is sort of inflation. Can you put your prices up? So Photo.me, which hasn't done a great deal this year, but recent results this week, dividend up 20% again. And the price of having your photo taken has gone from £5 to £6.
It's a ridiculous price.
But more interestingly, in France now, they've just won the contract. So you can go into a French Photo.me booth and you'll be able to have your picture taken, sign on the pad, have your fingerprint, and then they'll issue you the driving licence then and there. So, and this technology will actually work for passports.
So that's the thing, it's about that continuous evolution of it rather than just what it used to be.
According to the management of this company, the most forged passport in Europe is the British passport. They reckon between 2 and 6 million are forged.
Maybe not soon after Brexit.
So actually, they've diversified into laundries, which is another big sort of market for them. Hopefully they're going to clean up there. And then you've
bad.
Then you've got, but this whole security thing could be very big indeed.
Okay.
You just think all those things of getting someone to sign on the back of a picture. Yeah, this looks like Sarah Walker. I've known her for 10 minutes. Yeah.
Well, we do that all. No, we don't do that at all, do we? I mean, if we look over the last couple of years at Photo.me, I'm just going out back to 2013 there. We saw 2013 such a huge rise.
Yeah.
Since then, we've been in quite a bit of a channel. Where would you be looking to see the highs we saw back what would you be looking for?
I think this stock could do 20% next year.
Okay.
But in the meantime, your dividend's going up by 20% as well. So there aren't too many companies which are putting their dividend up by 20% and still got more cash in the bank now than they had at the start of the year.
So dividends, obviously, I know are key for you. Let's take another stock that you're looking at the moment, and that is Northgate. We're just 2016 here, the last couple of months for it, and we've seen, the last few weeks, beginning of December, and saw a big rise in the share price. We're now trading around that 475.
What does Northgate do? It's van hire, and I cycle to work in the mornings, so I keep an eye out on the white vans, both from a research and a sort of life preservation point of view, actually. And there's no shortage, trust me, of white vans on the road. They've got a new management team, the chairman's come in and sort of changed the chief exec, and a strong position in the Spanish market, good results the other day, and I feel that its stock is potentially on the turn now. Cheap, 8 or 9 times earnings, not trading a million miles above net asset value, and we've seen quite a lot of companies being taken over, not in this space, but Lavender in the higher spaces and Approach, even Punch Tavern. So I think anything which has got a bit of asset backing, decent cash flow, it's going to look attractive, I think, going into next year.
So this could be a takeover play for you.
It could be a takeover play, but also I just feel the fundamentals of the industry are changing in that it's always been white van man, and now you've sort of been able to, you see what Zip Van has done, or Zip Car, the whole way you rent cars and do these contracts is changing, and actually this lot should be at the forefront of that.
Okay, so that's Northgate. Another one you're looking at is Workspace Group. It's very interesting in the moment because I say normally you are very much all with the house builders, so it's great to see this kind of...
Well, you said to me, God, Andy, look, you're only coming on once more time if you can actually be vaguely interesting. Right.
You're always interesting. And what I love, do you know what I love about you, Andy, actually, is you talk about you cycling along and your mum and bring all this stuff in, because actually that's a really important part of the stock picking to a certain extent, isn't it? It's opening your eyes to what's around you.
Well, as Philip Green often says to me, the problem with common sense is it's not common. And people overcomplicate these sort of things. And so we're talking about Workspace. This is a stock which got absolutely hammered on Brexit, we didn't hold it then, and we started a position shortly after that. And this is how the city gets caught up. 3 numbers on the front page of this company's results: earnings up 15%, dividend up 40%, net asset value down 1%. Now, which number do you think the analysts focused on?
Let's think about that one. Yeah.
So actually, the way we work is changing. Okay, so co-working is becoming more and more prevalent. If you just walk down to Moorgate, there's a huge WeWorks there. If you go up to Camden, this whole co-working thing. Even Schroders, we're in our new office on London Wall, we're going to have agile desking.
So snap.
Agile desking, which means, so what I've been doing is going to yoga, Pilates, stretch, so I can just move effortlessly between desks. And Workspace have got this sort of market sort of cornered. So we took advantage of the price fall, and I think you're going to see more and more companies looking to take small amounts of space. I'm a big fan of the UK economy for the next few years, because I think the companies I see, both in a private basis and at the small end, incredibly entrepreneurial, and by having something like a Workspace, you can take a small amount of space and then you can grow with it. I do this thing for Prince Andrew, Pitch at the Palace.
I'm loving all these name dropping just
Pitch at the Palace, and one of them was called Doctify. About 18 months ago, and they started off with 2 workers up in Camden. They've now expanded to sort of 30, 35, and they've been able to do that. Flexible spaces, rents, low rents, leases 2 to 3 years, and so agile working and agile space, I think, go together. And should be a good share next year.
So will we back above the 850, which we saw before the Brexit referendum?
I think property looks good. I think it's quite interesting. Sovereign wealth funds immediately wrote down some of their London holdings and have now written them back. There's not a huge amount of space coming on. Rents are pretty solid, but people look at it on a yield basis. I try and look at these things on a sort of earnings basis, because that's what you're paying the dividends out of, is the earnings. Okay, on that note, we do have to leave it there, but thank you very much, Andy Brough there from Schroders. So 3 companies he's watching for 2017, Workspace, Northgate and Photo Me International.